This is Michael Fox, and this is the Prospector News podcast. And I have joining me from the National Investor, a longtime friend and contributor, Chris Temple. Welcome back and Happy New Year, Chris.
And belated Happy New Year to you too. We're starting to get our sea legs under us maybe a tiny bit, and as 2024 unfolds.
Yeah, no doubt. I used to remember, and it's a sign that you and I are old. I remember have to think really long and hard when you wrote a check to change the year on the check so it wouldn't come back. But who writes checks anymore, right, Chris?
No kidding. Yeah, it's I think for me it's pretty much my grandkids' birthdays, and that's about it. Not a whole lot more.
No, not a lot. So let's not go all the way back to the check writing days, but just back to the last year. 2023 was a bit of a wild year. There wasn't a whole lot of good out there. Did the year unfold the way you saw it unfold?
No, at the beginning of the year, I thought we were going to get somewhat of a continuation of what we had in 2022 with the Fed raising interest rates, inflation raging, even though it was looking like it would moderate somewhat and so forth. But the continuing strength, at least as far as some of the surface numbers are concerned for the economy, uh, the stock market, more or less, and there's exceptions in different sectors, but more or less getting back what it lost in 2022. No, I did not think we were going to see that. I did not think we would see long-term interest rates move to where they did, 5.5% on the long end at the peak. That's the Fed funds rate. 10-year Treasury touched 5%. And if you'd have told me a year before that with interest rates getting up to that level, the stock market would be rallying back to near its old all-time high, I would have called happy acres and sent for the rubber truck for you. But that's what happened. So, the stock market did better. The economy on the surface held up better. Inflation came down somewhat. But now we got a new year, and we've got to figure out how all of this plays out in a new year, which adds the dynamics of being an election year, which will be very volatile politically and otherwise, and adds the elements of a lot of global tension going on and warm wars turning a little bit hotter.
Yeah, no, there wasn't a whole lot to say good. If it came down to surprises, the two big surprises to me was that the U.S. economy remained as buoyant as it did, and the Fed so-called pivot that occurred at Christmas time, where they went from extreme hawkishness to extreme dovishness in like a 30-second speech.
Yeah, you and I talked about that after the fact, and I think we got to walk that back a little bit, frankly, Mike, because everything since Powell's dramatically different message, there's no question it was a dramatically different message as we talked about at the time. But since then, we've had Fed minutes come out. Since then, we've seen inflation firm up and even tick back up a little bit by a couple of measures. And the acceptance, I think, in the markets now is a bit more so that, okay, the markets in the immediate aftermath of the December FOMC meeting, plugging in the equivalent of 625 basis point rate cuts in 2024 is probably overdone. The truth, as things look today, will probably be closer to the Fed's own forecast of maybe three such cuts or the equivalent thereof in 2024, none of which we'll see until mid-year. So I think that the markets have swung back a bit more in that direction. And that's because of the continued strength of the economy. It's because of the continued resilience of the stock market, at least on the surface, and things like that. Simply put, there is no compelling reason why the Fed has to start lowering rates to save either the markets or the economy that we know about. Which therefore means that there's reasons for them to hold the fort as long as they can and let nature and the past rate hikes take their course and give them a bit more confidence that inflation will continue to trend lower. I don't think, and I've said this a million times, I don't think in the end, barring a depression, that we get back to a steady 2% inflation rate, because there's too many structural things that have changed that are going to make that impossible. But the Fed's going to have to try and pretend otherwise for as long as it can get away with it. And that's going to be one of the dynamics really this year, Mike, is if things go as I think they will, where the economy and economic statistics start to more broadly show that yes, a downturn finally is at hand. Is it going to be enough of a downturn where politically and otherwise the Fed is going to feel pressure to ease in an environment where inflation is not where they say they want it, let alone if it starts to go back higher a bit more than we saw this last month?
Yeah, no disagreement from me. And as I start to look, and let's start to look forward into 2024, I'm seeing a lot of things that run contrary to what the talking heads seem to be saying, and it makes me kind of wonder if the markets have front run the Fed too much in their anticipation of rate cuts in 2024. And like even the last jobs number, yeah, on the surface, it looked like a pretty decent jobs number. But when you started to scratch under the baseline information, a good chunk of those job gains we got were coming from government and coming from the health sector. So they weren't broad jobs coming into the economy. They were in very narrow focused areas, and government sector jobs aren't necessarily where you want to see your growth coming.
Well, they're not, no, and it's not like it's a bad situation, but I think it's a glass half empty situation. You know, Janet Yellen came out because, of course, she's a partisan Democrat and works for the Biden administration, crowing about the last jobs report and about how this kind of is evidence of a soft landing for the economy and blah blah blah. And of course, you know, she's political. She has very little wisdom in the things that she says. It's all talking points that they want the public and or the markets to believe. But look, the news out of the last employment report that she should have stressed in more of the context that it needs to be understood is that wage gains came in double what they were expected to be. Let's not forget that we have a wage and price spiral now underway. That's one of the many structural reasons I alluded to a minute ago, just one of the reasons why it's going to be very difficult and I think impossible to bring inflation back to 2%. You've got 7 and 8% across the board wage gains annualized that workers have been able to get from employers in the recent past. The high profile ones being the automakers and UPS drivers and some other ones, 20 to 30% wage gains. So that is not the stuff that brings you back to 2% sustained employment, because everybody starts to raise their prices to compensate for this. I saw a thing this over the weekend of somebody complaining that in Los Angeles they went out to eat, and among the new things in their bill, it reflects a 4% added tax besides the state income tax and whatever else for their employees, you know, increased benefits and whatnot. That's not the first place I've seen that story. Family run restaurant up in northern Wisconsin where I spend the summer. They just went and did that recently. Now, look, I don't object to that ethically or morally, but it's part of the equation. It is going to keep prices going up across the board. And that's not discussed by this little shrew who's the Treasury Secretary. So, anyways, you know, and you've got these price pressures and weakening job situation unfolding at a time when the recession is starting to set in a bit more. They can massage the headline numbers all they want, but especially when you look at manufacturing indices and things like that, um, you know, there's been a contraction globally for over a year now in a lot of, you know, bread and butter manufacturing economic activity. So I think that, you know, this word stagflation, or the term the great stagflation that I've used so many times, it started a couple of years ago. It's still with us. It's going to morph in which aspects of it are worse one minute as opposed to other ones. But this is the environment. And the Fed's job increasingly is going to be to keep the great stagflation from turning into a more substantial recession slash depression, or B, a runaway currency and then a hyperinflation crisis. Because one of the main questions in my mind as we start the year is, will the point come in 2024 where the Fed unquestionably, and whatever they want to call it, when if and when the time comes, I think it's when the time comes, when they have to basically run up the white flag and say we're through with all of our monetary tightening, even though inflation is going back up, if not feel compelled to start easing monetary policy anew, well before inflation is down to their target. That is where I think the destination is. The question is, does it happen this year?
Well, I think it's going to happen this year. Let's break out the CPI here for a second. It came in hotter than expected at 3.4%. But in those underlying numbers, here's a number of things that people really don't have a choice in where they're spending. Like if they've got a car insurance inflation was up 20.3%. God help you if the car breaks down.
Yeah.
That inflation rate was 7.1%. The transportation inflation to get all those goods and the supply chain onto the store shelves and into people's homes, up 10.1%. The homes themselves, rent inflation, 6.5%. Home ownership, up 6.3%. Don't get sick. Hospital services, this is more of a US thing and a Canada thing, but hospital service inflation up 5.5%. If you want to take a break from cooking, your takeout is up 5.2%. Probably some of those taxes you alluded to added into that. One of the things that I don't have is the actual food inflation, but everything I see when I'm going to the supermarket is up higher or is shrinking in packaging. These are things that people absolutely have to have: food on the table, roof over their heads, a way to get to work, and to stay healthy. And these
Right.
things are all going up astronomically. When does that start to hit the consumer in the pocketbook, and the consumer being the biggest push in the US economy, that they start to have to start cut back?
Well, it's already hitting. If you can look at half to 60% or so of the US population at the lowest to middle income levels, people are already pulling in their horns. And this again is going to this dynamic, Mike, is going to get worse as time goes on. And this is one of the reasons why the economy overall is going to start bogging down. It's because consumers who, as you point out correctly, drive 70% or so of overall economic activity here in the US, you just can't do it anymore. And now it's hunkered down. Now it's distinguishing between needs and wants, and it's trying to pay down debt. It's trying to keep from being foreclosed on or having your car repossessed if you've got one of those subprime car loans, which have seen record delinquencies in the recent past. I've used the example before, and this is where the economy is heading. And this is why when the Fed does start to ease, it's not going to help the economy. Let's say you and I were out here in St. Augustine, Florida. We went out to dinner. I can find a very nice passable meal for us, for including a couple of drinks, that'll cost us $100, and we'll get our fill. We'll have a couple of drinks, really nice meal, and so forth. And you and I are sitting at the table at the end of the evening, kind of stuffed, feeling pretty good, wondering, maybe we shouldn't have eaten as much or whatnot. But when the waiter comes over and we think it's to give us the check, he says, gentlemen, the chef wanted me to let you know that there's all kinds of food still back in the kitchen, and we don't want to throw it away. So you sit here and we're going to do the entire thing again from start to finish. You can have a couple more drinks, the same meals you had, similar ones of whatever you want to do, but we'll only add $50 to your bill. I don't care if he takes $50 off. I just physically can't eat anymore. And this increasingly is a position that consumers are in. Everybody went through the extra money they had when they didn't have to pay their student loans. Now some have to pay back their student loans. They went through the COVID money. Now that's not there. And a lot of this free stuff and a lot of this extra one-off help that consumers had in the last couple of years or so is gone. And so now we're back in this, and I think in some other respects, to reality. So you're going to see a broadening trend of consumers sitting on their hands. So I would say, for example, in that sense, that car prices, which, yeah, the inflation there has been worse, that's probably going to be less bad going forward. You're going to have some repossessions. You're going to have the rental car companies get rid of some fleets and they're going to go for lower prices and the aftermarket, whatever. Food is going to continue to go up. Services will continue to go up. The bad news in all of this, potentially, is that the stuff that should go down more in price now, as far as a lot of consumer goods, may not, because now global shipping rates have spiked astronomically, chiefly because of the conflict in the Middle East and in the Red Sea, and adding miles and costs to bringing stuff to our country.
Yeah, that's that conflict isn't helping matters. And another point that I like to make out of this here, there's a knock-on effect to those interest rate hikes that the Fed has had. If me as a homeowner, I don't have to renegotiate my mortgage for another 3 years. So I'm not affected by the Fed's interest rates until I have to renegotiate in 3 years' time. So as more and more people, I'm talking consumers, have to renegotiate their mortgage rates, they're going to start to get the knock-on effect of the higher interest rates. And same with corporations. If they had a 5-year bond or a 10-year bond that's not due right away, they're not feeling the effect of those higher interest rates until those bonds become due and they have to renegotiate that debt. And I think that we're going to see over the course of the next year, 2 years, the knock-on effect of these higher interest rates. And that's going to put increasingly more recessionary pressures on this economy. And the question is, if we have high inflation and all these recessionary pressures, something has to give, either the interest rates or the economy.
Well, I think that you're going to see some of that happen both. First of all, Mike, I think that when it comes, and I'm speaking strictly of the US markets, when it comes to the average homeowner, even after this rise in interest rates, most are in relatively better shape than they were when everybody was far more leveraged and using far more short-term mortgage paper in the preceding time to the 2008, 9, 10, to that whole real estate bust back then. The majority of mortgages on the books overall for US homeowners were done in the COVID and immediately after COVID years, all at lower rates. And it's one of the reasons why the housing market, as far as prices are concerned, has stayed as strong as it has. There's been some broadening weakness finally in the recent past, but not, what you would have thought would happen again. If, a year ago, if you'd have told me that mortgage rates on a 30-year are going to go up and touch 8%, and yet in more markets than not, real estate prices are going to stay at their highs, I'd say another one. Let's send, call Happy Acres and send, have them send a rubber truck. But that happened, and it happened because the result of those higher mortgage rates is that no one was putting their house on the market unless you had a gun to your head for some, work reason or family reason or whatever reason to have to move. Who's going to move for whatever reason and trade, an 8% or a 3% mortgage for an 8% mortgage? So a lot of houses have stayed off the market, and that has had the supply very crimped in a lot of places. And I'm speaking in general terms. There's exceptions to this everywhere. So I don't see necessarily the follow-on effects of high interest rates hurting residential real estate that much. There will be some, those people who, for whatever silly reason, got an adjustable rate mortgage when rates were at their lows. Well, yeah, they're going to have to pay up now. But I'll tell you where we are going to see finally some comeuppance, and this is another big thing to watch in this year ahead, Mike, is where commercial real estate is concerned. I read a piece not long ago about a big commercial property, one of the biggest dollar transactions in the US in the last year, a big commercial property in Los Angeles that changed hands, but it changed hands at roughly half of what it had sold for the last sale. And so there's an awful lot of commercial property out there where, due to either the debt rolling over, which is more likely to be the case with such properties, or where the market simply has collapsed demand wise, there's going to be some cracks opening up. We may see this year events similar to what we had when a handful of banks early in 2023 were in trouble. This time around, it's going to be those holding the paper on commercial property where there's insolvencies and maybe some bankruptcies because the math just doesn't add up. For economic reasons, for demographic reasons, because a lot more people found out they could work at home, you've got commercial real estate in major cities all over the US that's half or two-thirds full. You can't pay the bills on that. And so the owners of those properties are going to try and put them up for sale. Well, who the hell wants them now? With under those circumstances. So you could finally, and this has been a long time brewing, you could finally see a credit crisis that's going to have reverberations in the economy from commercial real estate, just like it was chiefly residential real estate that caused these things in 2007, 8, and 9.
Yeah, I'm in agreement with you. I think the potential of a commercial real estate bust is there. And I think it's going to have a bigger knock-on effect than what people realize, because within each of those commercial properties, there's janitorial staff, maintenance staff, security staff, and people that are there to look after the building and maintain the function for the people that work in the building. And if those buildings stop becoming commercial entities, and let's go worst case scenario, become virtually vacant, a lot of those people are going to find themselves out of work.
Yeah. Yeah. So look, I do believe that is going to be one of the factors that will lead to less animal spirits by lenders. It will start to more notably curtail the availability of credit for these type of things. And as people lose their jobs and get scared and whatnot, yeah, it's going to have a dampening effect overall on economic activity.
So as we've gone through all these economic factors, it's becoming increasingly clear that we're heading for a recession, and the markets are out over their skis on what they think the Fed is going to do. So what do you think will happen with the markets in 2024? Are we potentially looking at a significant fast move downward, or is this going to be a long, slow ache?
I think it's going to be a long, slow ache. I mean, some people are biased in favor of stocks as we begin the year because stocks in a presidential election year are supposed to go up. And in fact, most of the time they do, at least somewhat. The two more notable exceptions in recent years were when you had, um, believe it or not, you had bubbles that were unwinding or beginning to unwind. So in the year 2000, that presidential election year, the market was poor. And in the year 2008, that was poor because you had a lot of these dominoes already falling. So, I think that the odds are at least calculable that we could have the same situation this year. The question is whether the Fed can hold things off long enough to get us past the election. That's an open question. But you have some people going into the year believing that. And the other thing you have people going into the year believing, right or wrong, is that the Fed at some point, whether you want to argue that it's March or June or whatever, is going to start lowering interest rates before the year is over. And they believe that will be the sign that longer term market interest rates will come down, and that will make equities and other risk assets relatively more attractive, all else being equal, and et cetera. The problem is when you go back and look at history, after the Fed has kept interest rates steady for a number of months, when the point comes that they finally do start to actually lower interest rates, the die is already cast and we're already in a recession and things are already deteriorating. And historically, once the actual rate cuts start coming, that's when the worst declines happen for the stock market, because the Fed is now reacting to all these other bad things finally catching up to stocks and the economy both. So look, I think when you smooth it all out, and keep in mind too that there is much more liquidity still sloshing around than at those similar junctures in the past. You've had record highs for a while now in money market mutual funds, so there's fuel there, arguably, for the market, et cetera. I think we go back. We're certainly not going to have another 2023. I think we go back to what 2022 was, where we plod along. I think that the major indices will end the year lower, not necessarily alarmingly lower, but you will have a changing of the guard again, will be the bigger story. And those sectors and those areas where investors wake up and say, okay, the great stagflation is here. Yes, we're going into recession, but the Fed's going to be limited as to what it can do early on because inflation is still high. What do we do in a stagflationary environment? So I think old energy is going to have a major rebound year. I don't believe either oil or even natural gas prices, after this weather-related pop that we have had so far, I think that they both end the year higher for a lot of supply issues and geopolitical issues both. That's going to keep inflation elevated, but it means that old energy is going to be one of the best performing sectors this year, like it was in 2022. I don't think that's going to, unfortunately, be shared by resources across the board. However, I think that near term, there's still going to be some pain. And I don't care how good the fundamental stories are about things like copper and nickel and the rest, and I love them long term. I've got recommendations of individual companies in these areas long term, but I think we're going to have to ride them out and be more patient. They'll really start taking off when the Fed has to ease dramatically, and then the much broader monetary inflation that will return will help these other areas. So we're going to be in kind of a no man's land. This year, the themes, besides, good dividend paying stocks that have got good earnings and can cover their dividend, and things like some REITs, energy pipelines, consumer non-discretionary, and some other areas. I think you look in order of importance: uranium number one, old energy number two, and precious metals number three.
Yeah, I wouldn't disagree with any of that. I think until certain things get sorted out, and we started to step into that politics as you're heading into this election, Chris. I got to look at it and I see $34 trillion in debt and soaring. And I have to wonder, is this going to be an election issue, or are the party's going to run amok and, spend like drunken sailors and promise the world to everybody with their own money?
Well, the main ways in which to reduce the deficit, um, you're not going to get any meaningfully different answer from either Biden or Trump, assuming that's who it is. The biggest reason why I did not support Donald Trump in 2020, even though I did in 2016, is he dramatically broke his promise to rein in the deep state and the military industrial complex and NATO, all three. What we ended up with from him was an environment where he was browbeating everybody else to go run themselves into the poorhouse, spending money on defense. So his promises to rein in this monstrosity that has made the whole world unsafe and now has us on the edge of three major wars, his promises to do away with that ended up being he wanted everybody else to pay their fair share to get us to that point. So anything he says to the contrary right now is nonsense. I'm not listening to it. I believe a Bobby Kennedy or a Rand Paul or a Marianne Williamson or some of these other third party candidates, because they have a track record of wanting to gut the military, make the world safer, and as a result, bring down our deficits. Donald Trump did not do that, and I don't think he would do that if he's reelected. Biden has clearly proven that that's the case with him. The reason why the establishment wanted him rather than Trump in the last election and make sure they had their thumb on the scale to achieve that outcome is that there was never a question whether Biden would slavishly go along with starting wars, running up the military budget and stuff like that. So you're not going to get any different take on either one of them. Both of them, Trump even more so, whines about the Fed, and the Fed needs to lower interest rates. And if I'm reelected, I'm not going to reappoint Jerome Powell, blah, blah, blah. Well, if Donald Trump had had his way when he was president, we'd have even higher inflation now and higher debt servicing costs now because he wanted the Fed to really go nuts on monetary inflation, which of course has brought us to this point. And all because Donald Trump, and this is a story for another day, we don't have time today, took office wanting to be a mercantilist. History buffs know what I'm talking about. If you're not, you need to go back and look at how US policy was run in the late 19th and early 20th centuries. So nobody in that rambling answer is going to say, or they might say a lot of things about it, but nobody's going to do anything about this debt issue. And the only thing that's going to save the US near term, Mike, because of that, is that everybody else is in worse shape, relatively speaking, than the US is when it comes to debt. So, it's a sad situation, but that's what we got.
Yeah, well, and the other elephant in that political room is you got two doddering old men that are stumbling along in their speeches. You've got Biden that looks like he could keel over and die at any moment, and then you've got Trump that's rambling on like a drunken peepaw. um is there going to be a surprise? Are either one of those candidates going to reach the finish line, or is something going to happen and we're going to have candidates that we don't expect?
Oh, I think the odds are better than 50-50 that at least in one case we're going to have a candidate that we don't expect. I question whether, and frankly, in that context, my gut tells me, and I don't care for either one of them. I guess if you put a gun to my head and it was either pull the trigger or tell me, do you want Trump or Biden? I'd have to hold my nose and say Trump. But I think Biden especially is vulnerable. There are so many negatives that even with the negatives that Trump has, Biden's negatives are now far worse. And that concerns me because if he is still going to be insistent on staying in there and or the establishment is going to stay insistent on keeping him in there, a man who now has got more negatives than Donald Trump does, and I think in a head-to-head contest would indeed lose to Trump in a rematch. What do they have to do to make sure Biden stays in or Biden's successor stays in? And what concerns me is that the answer to that question is going to be one or more much broader wars where the selling point will be we can't have Trump in there because if the war is with Russia, he's too friendly with Russia, or he doesn't have the right policies on China or whatever. War has always been the thing that scoundrels can wave the flag over and say, you got to reelect me. The old saying is patriotism is the last refuge of a scoundrel. And that's especially true in electoral politics when you start a war and say, you got to keep me in there because I'm the guy who's going to protect you and know how to take care of things. So it concerns me that for not only that reason, Mike, but also to take the heat off the Fed and a deteriorating economy. War is a great scapegoat. War is a great excuse to run even higher debts, etc. So it concerns me greatly. We don't know at what point the Middle East really blows up. Thankfully, Europe itself, having been led down the garden path by the US/NATO and had a shambles made of its economy and its own strategic position, they're getting sick of the whole thing with Ukraine that the US started. And I think we'll be much more supportive of finally a deal to stop this bloodshed and attrition there.
Yeah.
The big thing looming in the background is still China. The voting booths in Taiwan this past weekend hadn't even cooled off yet, and Biden is sending a delegation to Taipei to poke his finger in China's eye again. So that still looms out there.
Yeah, well, I was gonna go down through the list of conflicts and potential conflicts. There's the Russian-Ukraine one. Yeah, you're right to some extent, but I was reading reports out of Sweden where their government is telling their citizens to be prepared for war. So is that really a cooling down of the situation over in Europe? As we record this today on the 15th of January, a U.S. cargo ship was sunk in the Red Sea by by the Houthis. So that Middle Eastern conflict seems to looking like it's going to spiral out. And as you alluded to, Taiwan poked China in the eye and elected a pro-Western, the pro-Western government back into power. And where does that leave that potential China to Taiwan conflict? And so yeah, you're right. The last bastion for the scoundrel is certainly there, and it's looking like it's going to raise its ugly head here in 2024.
Well, look, I have to repeat, and I think you and I have mentioned this before. I know I do it from time to time, but don't lose sight of what happened on September 11th, 2001, where it concerns economic expectations and blame shifting. Okay. Up until September 11th or September 10th, 2001, the chatter increasingly was that this vaunted maestro, Alan Greenspan, was a screw up after all, that he had blown these bubbles in the 1990s, let the derivatives markets run amok, let the tech bubble get out of hand through monetary policy, made it even worse by not lowering rates soon enough and actually tightening rates into the downturn initially in 2000. And so here's a guy who's a nitwit. Bush's policies, Bush Jr.'s policies were questioned, everything like that. And up until September 10th, 2001, there was a healthy debate that had started over, do we need to overhaul the Fed? Do we need to make it more accountable? Do we need to know more about what this wizard is doing behind the curtain, et cetera, et cetera? That all changed the next day. And what ended up being a worsening bear market and a worsening recession was no longer the fault of Alan Greenspan or any other policymakers. It was responsibility and the cause of 19 terrorists. And believe you me, there's any number of scenarios that, where there's been war games or political games on the shelf that these people play that, if this happens in the Middle East, this is how we blame shift. This is how we take the heat off the Fed and interest rate policy and stuff, because it's those darn Houthis that have caused oil to spike. It's those darn Iranians that have done this or that, and look, there's people jockeying that there's people salivating over a war. You've got a deranged person like Mike Pence recently who was actually autographing missiles that the Israeli military was going to use to bomb Gaza. You've got deranged people that the Orange Wonder hired, John Bolton, who has for years been pining to attack Iran and now might get his wish. So these people are sociopaths. They have not served the U.S. citizens and voters well at all. And they're going to cause a lot of trouble going forward. And again, my big fear, what started this whole discussion, Mike, is that they won't stop it fomenting more conflict and having one of these hot spots really go nuts, because that then becomes a story and it takes the story off of Biden allowing an invasion of the U.S. It takes a story off of Biden running the deficit higher than any of his predecessors ever even dreamed of, et cetera.
Yeah, well, sadly, that's a reality. So we live in interesting times, Chris, as the curse says.
We
If
sure
people
do.
wish to follow your musings and keep on top of an ever-changing world, and one thing I think we're going to see throughout 2024 is change is going to be constant here.
Oh
How
yeah.
would they do so?
Well, just visit nationalinvestor.com. Make sure if you're not already on it, you sign up for my email list. Follow me on social media. There's links to that on the front page as well. And you're right. I mean, this is going to be there's going to be a lot of moving targets, a lot of volatility and ups and downs. Um, and if it is Biden and Trump that end up being the two final main combatants, it's it's going to make 2016 and 2020 both look very tame in comparison. And I think at some point, this type of a matchup may actually have some impact on the mood of the country and consumers generally, and maybe even the markets. It's going to bear watching. But yeah, we've had COVID, we've had the Fed jack up interest rates to multi-decade highs to fight multi-decade high inflation. We've had all of these different things, and just when you think things can't get any more crazy and convoluted, we're probably going to see more crazy and convoluted in 2024.
Yeah, never underestimate crazy. He always says, "Hold my beer."
That's right.
Till we talk again next. Let's leave that here and look forward to our next chat probably in a couple of weeks.
Great. Take care, Mike.
The Prospector News podcast is for educational purposes only. The opinions expressed are those of the participants and are not to be taken as investment advice. Listeners need to do their own due diligence and seek advice of a licensed investment advisor.